What if I told you that almost every major financial crisis in modern history, from the Great Depression to the 2008 housing collapse, shares a single invisible thread? It's a force so subtle, so systemic, that most people don't even realize it exists yet. It shapes the lives of billions. A force that profits whenever countries borrow, citizens consume on credit, or economies teeter on the edge of collapse. Who controls it? How does it thrive on crisis? And why, despite repeated warnings, does it continue to dominate our financial systems? Today, we're going to uncover the hidden mechanisms behind global debt, trace their origins across centuries, and reveal how ordinary people, nations, and even entire continents become trapped in cycles that consistently enrich the few at the expense of the many. By the end, you may never look at your money or your government's balance sheet the same way again. Debt is not new. Historians have found records of loans dating back 4,000 years inscribed on clay tablets in Mesopotamia. These weren't just casual agreements, they often included interest rates, penalties, and strict repayment schedules. The fundamental principle is simple. Someone provides capital up front, expecting repayment with profit. But history shows that when this mechanism is amplified through governments, central banks, or international trade, it becomes a tool of control. In the 17th century, England created the Bank of England, and the Dutch East India Company emerged as a global trading empire. Suddenly, debt was no longer a private transaction. It became a national and international instrument. Nathan Meyer Rothschild and other financiers didn't merely accumulate wealth, they engineered systems where nations themselves became dependent on debt. Wars, economic depressions, and even revolutions became opportunities to profit. Governments would borrow to fund wars, and when repayment crises emerged, financiers could manipulate markets, bonds, and interest rates to turn massive profits. Debt, in other words, was never neutral. It became a vehicle of power. Patterns started emerging. Countries borrowed for growth or survival. Crises struck, and those positioned to control the flow of money always benefited. Ordinary people often bore the cost, while financiers and creditors profited. This recurring cycle would repeat, century after century, evolving into the modern debt system we know today. With the Industrial Revolution, the scale of debt grew exponentially. Entire nations needed capital to build railways, canals, and factories. Governments were no longer just borrowing to fight wars, they were borrowing to industrialize. Take Britain in the early 1800s. Railways were critical for connecting industrial centers, but the cost was astronomical. Bonds were issued, and financiers like the Rothschild family stepped in, lending money at interest rates that ensured enormous profits. But it wasn't just profit, it was control. By holding a nation's debt, financiers effectively held influence over national policy. Governments had to negotiate and cooperate with lenders even when their citizens were struggling. Debt became both a sword and a leash, and these patterns repeated globally. In France, Germany, and the United States, large banking families financed industrial expansion, profiting from both booms and crises. Every panic, whether a failed investment or economic downturn, was a calculated risk for these institutions, and often they were positioned to benefit from the fallout. The lesson was clear. Whoever controlled credit controlled the economy. Debt, properly leveraged, became a tool to shape nations, industries, and entire continents. The 20th century brought unprecedented change. World War I left Europe financially devastated. Nations borrowed massively to fund military campaigns, issuing bonds and seeking loans from private banks and allied countries. When the war ended, economies were fragile, but creditors continued to profit. Germany, for example, was forced to pay reparations after the Treaty of Versailles. Its economy collapsed under debt obligations, creating the conditions for hyperinflation and political upheaval. Yet, international bankers and lenders had structured their investments to minimize their own risk and maximize profit. Then came the Great Depression. The 1929 stock market crash wiped out millions of savings in the United States. Yet those who had bet against the market or manipulated credit instruments emerged wealthier than ever. Banks collapsed, governments intervened, and ordinary citizens bore the brunt of unemployment and poverty. This was not random, it was a systemic pattern repeating itself across decades. Boom, collapse, profit. And the mechanisms of modern debt were fully in play. World War II further institutionalized global debt. Nations borrowed heavily to finance the war. Post-war, the United States created the Marshall Plan and global financial institutions like the IMF and World Bank. These programs were presented as tools for reconstruction, but they also entrenched debt dependency. Countries rebuilding after war often had to borrow from these institutions, agreeing to conditions that shifted economic control to creditors. Debt was no longer a side effect of war, it was a permanent feature of international relations. Through the 20th century, debt became a predictable, global, and highly profitable system for those who controlled the flow of money. The debt cycle became fully visible in practice. In Latin America during the 1980s, governments borrowed heavily in US dollars to fund industrialization and infrastructure projects. When global interest rates rose, debt repayments became impossible. The IMF stepped in with structural adjustment programs requiring austerity, privatization, and economic reforms. Citizens faced unemployment, poverty, and reduced social services. But international banks recovered their loans and even profited from rescheduled repayments. In Asia, 1997, Thailand, Indonesia, South Korea, and other nations borrowed massively in foreign currency to finance rapid growth. When currencies devalued, debt obligations ballooned. Governments had to accept international bailouts, transferring economic control to creditors. Investors and speculators profited from currency fluctuations and market collapses. In 2008, the global financial crisis exposed debt systems on a massive scale. Subprime mortgages in the United States were bundled into complex derivatives and sold worldwide. When the housing bubble burst, banks collapsed. Governments injected trillions in bailouts to stabilize the system, while key financial players positioned to benefit from market instability made billions. Ordinary Americans lost homes, savings, and jobs. Across all these events, the pattern is clear: debt drives growth, creates instability, and generates concentrated profit for those with foresight, leverage, and control over credit. After every crisis, governments attempt fixes. Sometimes they forgive debt, restructure loans, or impose new regulations. But despite these measures, the underlying mechanisms that allow a small group to profit remain largely intact. Take Greece after 2008. The country's national debt had ballooned due to years of borrowing and unsustainable budgets. The European Union and IMF imposed harsh austerity measures, cuts to pensions, public sector layoffs, and tax hikes. Citizens endured immense hardship, yet banks and bondholders, the creditors, were shielded from loss. Structural problems remained, and Greece remained mired in debt cycles for years. The U.S. student loan crisis tells a similar story on a personal scale. Millions of students borrow trillions of dollars to finance higher education. Interest and servicing fees create steady profits for lenders, while graduates struggle with repayment. Government attempts to reform or forgive debt are partial at best, leaving the system intact. These examples illustrate a fundamental truth. Failed fixes are rarely accidental. They preserve the profitability of debt for those who control it while passing risk and hardship onto the public. Today, the debt cycle is global. Its governments, corporations, and individuals carry record-breaking levels of debt. According to the Institute of International Finance, global debt surpassed $350 trillion in 2024. More than 4 times the combined annual income of every person on Earth. The United States alone owes over $35 trillion in national debt. Corporate debt is exploding. Household debt is rising faster than wages, and even digital finance, cryptocurrencies. Derivatives, decentralized finance has created new ways to profit from debt cycles. Patterns repeat. Countries borrow, crises occur, and profits are extracted. Ordinary citizens, while earning and spending, are effectively funding the profits of those positioned at the top of the debt hierarchy. Shocking statistics reveal the scale global debt to GDP ratio has reached. 360% household debt in advanced economies averages over 100% of annual income, and U.S. student loans exceed $1.9 trillion. Even emerging markets face the same dynamic, borrowing in foreign currency and risking defaults that create profit for international creditors. History is not only repeating itself, it is accelerating. From these centuries of experience, 3 key lessons emerge. First, debt is a tool of power, not just finance. Understanding who benefits is critical. Second, crises are predictable and exploitable. Recognizing historical patterns allows us to anticipate risks. Third, temporary fixes rarely solve structural problems. Debt cycles persist because the system is designed to extract profit and maintain control. Real reform requires systemic change, not surface-level interventions. The hidden force profiting from global debt is not going away. If current trends continue rising, global debt, speculative financial instruments, and insufficient systemic reform, the next crisis could dwarf anything we've seen before. And when it comes, the stakes are not just financial, they are social, political, and even existential. Citizens may face austerity, governments may face defaults, and global stability could be at risk. The question is not if debt will create another crisis, is when and who will profit this time. Will history continue to favor the few, or will society finally break the cycle? This story opened your eyes. There are steps you can take: educate yourself, follow the financial systems that shape your life, and question who benefits from the debt you, your country, or your economy carries. Share this video to inform others, subscribe for more deep dives into the hidden mechanisms shaping our world, and stay aware. Knowledge is power, and in the world of debt, it may be your most important shield.